Hello everyone, welcome to the 75th episode of me learning how to trade in Forex. So in the last video we went through the impulse waves. So the 5-wave pattern is called impulse wave, the 3-wave pattern is called corrective waves. So 1, 2, 3, 4, 5. So 1, 2, 3, 4, 5. Yep. We learned about what each section of the wave means, so what wave 1 means, wave 2 means, wave 3 means, wave 4 and wave 5. And then we also learnt that out of the waves that are like rising or falling, I guess, so 1, 3, 5, there's always going to be one wave that's going to be longer than the other two. So and now we are currently on corrective waves, so let's get started. Corrective waves. Corrective waves. The 5-wave trends are then corrected and reversed by 3-wave counter trends. So this happens after the 5-wave trend. So 5-wave trends are then corrected and reversed by 3-wave trends, counter trends. Letters are used instead of numbers to track the correction. Check out this example of a smoking hot corrective 3-wave pattern. So 1, this is the original 5, and I've got A, B, C. Just because we've been using a bull market as my primary example doesn't mean that Elliott wave theory doesn't work on the bear markets. The same 5-3 wave pattern can look like this. What was it? Just done that. There we go. So that's the corrective 3-wave pattern for bull market. Looks like that. Then corrective wave pattern for bear market. Looks like this. Also, kind of mirrors each other actually, doesn't it? Oh damn. Okay. Types of corrective wave patterns. According to Elliott, there are 21 corrective ABC patterns, ranging from simple to complex. 21, I can't memorize all of that. The basics of the Elliott wave theory are already mind-blowing. Take it easy, young Padawan. The great thing about Elliott wave is that you don't have to be above the legal drinking age to trade it. You don't have to get a fake ID or memorize all 21 types of corrective ABC patterns, because they are just made up of 3 very simple, easy to understand formations. Let's take a look at these 3 formations. The examples below apply to uptrends, but you can just invert them if you're dealing with a downtrend. So the zigzag formation. So wait, there are 21 corrective ABC patterns. The zigzag formation. So zigzag formation, zigzags looks like this. Zigzag formations are very steep moves in price that go against the predominant trend. So the examples below apply to uptrends. So this happens after this bit here, after an uptrend. Zigzag formations are very steep moves in price that go against the predominant trend. Apply to uptrends. So the zigzag formation after an uptrend are very steep moves in price that go against the predominant trend. Steep moves in price that go against the predominant trend. Wave B, so this one here, is typically shortest in length compared to waves A and C. Wave B is typically the shortest compared to in length compared to wave A and C. These zigzag patterns can happen twice or even thrice in a correction. 2 to 3 zigzag patterns linked together. So go like that, and then also go like that. Or does B just happen to just go like that? Zigzag patterns can happen twice or even thrice in a correction. So 2 to 3 zigzag patterns linked together. Like with all waves, each of the waves in zigzag patterns can be broken up into 5 wave patterns. Each of the waves in the zigzag patterns could be broken up into 5 wave patterns. What? How can it be broken up into 5? When there's only 3 lines. Okay. The flat formation. The flat formation. So a W flat formations are simple sideways corrective patterns. Sideways corrective patterns. In flats, the length of the waves are generally equal in length. Length of the waves are generally equal in length, with wave B reversing wave A's move and wave C undoing wave B's move. We say generally because wave B can sometimes go beyond the beginning of wave A, so wave B will go like shoot up above that there. So wave B, however, wave B can sometimes go above the beginning of wave A. The triangle formation. The triangle formation. Triangle formations are corrective patterns that are bound by either converging or diverging trend lines. Corrective patterns that are bound by either converging, so they come in together towards one point, or diverging, so they start spreading out, trend lines. So trend lines are these solid black lines. Triangles are made up of 5 waves that move against the trend in a sideways fashion. Triangles are made up of 5 waves that move against the trend in a sideways fashion. These triangles can be symmetrical, descending, ascending, or expanding. These triangles can be descending, ascending, symmetrical, and or expanding. What's expanding triangles? Fractals, Elliott waves within an Elliott wave. So this is when we got up to the bit where like we can see mini Elliott waves within Elliott waves. Fractals, Elliott waves within an Elliott wave. Yep. Like we mentioned earlier, Elliott waves are fractals. Fractals. Each wave is made up of subwaves, huh? Let me show you another picture. Pictures are great, aren't they? Yeehaw. Right, so that makes up of one. So that's the 5-wave pattern, and this is the ABC 3-wave corrective one. That makes it go down. Okay. Do you see how waves 1, 3 and 5 are made up of smaller 5-wave impulse patterns, whilst waves 2 and 4 are made up of smaller 3-wave corrective patterns? You're seeing fractals. So waves 1, 3 and 5 are made up of smaller 5-wave impulse pattern. Waves 2 and 4 are made up of smaller 3-wave corrective pattern. You're seeing fractals. Always remember that each wave is comprised of smaller wave patterns. This pattern repeats itself forever. So as you zoom in on like one of these, for example, that's gonna like apply to all of that. Right, okay. To make it easier to label these waves, the Elliott wave theory has assigned a series of categories to the waves in order of the largest to the smallest. They are grand supercycle, multi-century, supercycle about 4 to 70 years, cycle 1 year to several years. Well, that's a big jump, isn't it? 40. Wait, multi-century. So century is 100 years. Oh, right, okay, never mind. Cycle 1 year to several years. Primary, a few months to a couple of years. Intermediate, weeks to months. Minor, weeks. Minute, days. Minuet, hours. Sub-minuet, minutes. A grand supercycle is made up of supercycle waves, which are made up of cycle waves, which are made up of primary waves, which is made up of intermediate waves, which are made up of minor waves, which are made up of minute waves, which are made up of minuet waves, which are made up of subminuet waves. Did you get all that? Okay, to make things clearer, let's see how an Elliott wave looks in real life. As you can see, waves aren't shaped perfectly in real life. So this is 1, 2, 3, 4, 5, and then the correctives A, B, and C. So that's a zigzag, isn't it? A, B, and C, right? Steep moves, A, B, and C. Yeah, that's a zigzag. As you can see, waves aren't shaped perfectly in real life. You will also learn sometimes difficult to label waves, but the more you stare at charts, the better you'll get. Besides, we're not going to let you go at it alone. In the following sections, we'll give you some tips on how to correctly and easily identify waves, as well as teach you how to trade using Elliott waves. Surfs up. Okay. Three cardinal rules of the Elliott wave theory. Three cardinal rules of the Elliott wave theory. As you may have guessed, the key to using the Elliott wave theory in trading is all about being able to correctly identify waves. By developing the right eye and recognizing what wave the market is in, you will be able to find out which side of the market to trade on, long or short. There are three cardinal cannot be broken rules in labeling waves. So before you jump right into applying the Elliott wave theory to your trading, you must take note of the rules below. Failing to label waves correctly can prove disastrous to your account. Three cardinal rules to the Elliott wave theory. Rule number 1, wave 3 can never be the shortest impulse wave. So rule number 1, wave 3 can never be the shortest impulse wave. Rule number 2, I can't type. Wave 2 can never go beyond the start of wave 1. Wave 2 can never go beyond the start of wave 1. Rule number 3, wave 4 can never cross in the same price area as wave 1. Cross in the same price area as wave 1. Cross in the same price. So wait. Rule number 1, wave 3 can never be the shortest impulse wave. So this one here can never, so these two can never be longer than this one here. So it can't have like that. That won't work. It has to be like that. Wave 2 can never go beyond the start of wave 1. So the wave 2 can never drop below here. Wave 4 can never cross in the same price area as wave 1. Wave 4 can never cross in the same price area. So this one here can never go like down all the way over here, I'm assuming, where this area is like, pretend there's like two lines. So wave 4 can never drop into this sort of area, I'm assuming that's what it means. Elliott wave trading guidelines. Then there are the guidelines that help you correctly label waves. Unlike the three cardinal rules, these guidelines can be broken. Here they are. Sometimes wave 5 does not move beyond the end of wave 3. This is called truncation. Sometimes wave 5 does not move beyond the end of wave 3. This is called truncation. Wave 5, more often than not, goes beyond our or breaks through the trend line drawn off wave 3 parallel to a trend line connecting the start of waves 3 and 5. What? Wait. Let me just write that and reread it myself. Wave 5 more often than not goes beyond or breaks through the trend line drawn off wave 3 parallel to a trend line connecting the start of wave 3 of waves 3 and 5. Wait, wave 5. I don't know why it says waves. So this one here, more often than not, goes beyond or breaks through the trend line drawn off wave 3. So trend line drawn off wave 3, so this trend line here breaks through the trend line, so it would go like drawn off a trend wave 3 parallel to a trend line connecting the start of waves 3 and 5. Connecting start of waves 3 and 5. Wait, so that's that. Wave 5. Why is this window so big? Wave 5. So this is this one here. More often than not goes beyond or breaks through the trend line drawn off wave 3 parallel to a trend line connecting the starts of waves 3 and 5. So this is wave 3, the start of waves 3 and 5. So so you got line here that's connecting the start of waves 3 and 5, drawn off wave 3 parallel to a trend line. So if I draw a trend line here like that, these two lines are meant to be parallel, so they're saying that this wave 5 here is going to break through, not like that, is going to continue to break through that line there, I think. Huh. Okay. I can't really, like, without an example, it's hard to try to imagine it. So yeah. Okay. Wave 3 tends to be very long, sharp and extended. Wave 3 tends to be very long, sharp and extended. Waves 2 and 4 frequently bounce off Fibonacci retracement levels. Frequently bounce off Fibonacci retracement levels. So these are the guidelines, so they don't always happen. Wave 3 tends to be very long, sharp and extended, so this one here. Waves 2 and 4, so this one and this one, frequently bounce off Fibonacci retracement levels. Right, okay. Okay. How to trade Forex using Elliott waves. Trade Forex using Elliott waves. So, this is probably what you've all been waiting for. Drum roll please, using the Elliott wave theory in Forex trading. As an Elliott wave trader, you'll be spotting wave counts. So, identifying which section of the wave the current market is in, I'm assuming. This means that you will be labeling the waves to see how they conform to the Elliott wave pattern to try and anticipate future price movement. To use the Elliott. To trade using the Elliott wave theory. You'll be labeling the waves to see how they conform to the Elliott wave pattern. In this section we'll look at some setups and apply our knowledge of Elliott wave to determine entry, stop loss and exit points. Serves up. Hypothetical will most probably be right scenario number 1. Let's say you wanted to begin your wave count. You see that price seems to have bottomed out and has begun a new move upwards. Using your knowledge of Elliott wave, you label this move as wave 1 and the retracement as wave 2. So wave 1 is that bit here, retracement is level 2 there. What's next? In order to find a good entry point, you head back to the school of Pipsology to find out which of the 3 cardinal rules and guidelines you could apply. Here's what you found out. Rule number 2. Wave 2 can never go beyond the start of wave 1. Okay, so this wave here can never go beyond this point here. So like it can't be dropping below over here. Waves 2 and 4 frequently bounce off Fibonacci retracement levels. So we could turn the Fibonacci retracement levels on and then see if it bounces off like resistance 1 or whatever. So using your superior Elliott wave trading skills, you decide to pop the Fibonacci tool and see if the price is at a fib level. Holy mama. Price is just chilling like ice cream filling. Around the 50% level. This could be the start of wave 3, which is a very strong buy signal. So around here, stop loss. Oh, stop loss is put here. Since you're a smart Forex trader, you also take your stop into consideration. Cardinal number rule states that wave 2 can never go beyond the start of wave 1, so you set your stop below the former lows. So below here. If the price retraces more than 100% of wave 1, then your wave count is wrong. Let's see what happens next. Boom. Shoot up. Wave 3, awesome. Your Elliott wave analysis paid off and you caught a huge upward move. You go to Las Vegas or Macau, overconfident that everything you touch is a winner. Blow all your Forex profits on roulette and end right back where you started. There are no Elliott waves in the casino. Lucky for you, you have another hypothetical scenario where you can earn imaginary money again. Scenario 2. This time let's use the knowledge on corrective wave patterns to grab those pips. So 1, 2, 3, 4, 5. Right, that's for a bear one. 1, 2, 3, 4, 5. 1 is down, 2 is up, 3 is down again, 4 is up, 5 is down. Yep. Flat formation beginning of wave 1 soon. So remember, flat formation is when it's like a W. So A5 W should be like here. A, B, C. but A's upward here and A's downward here. So A, B, C. Oh, so it's like an M now then. Oh, because this only applies for upwards trend. Oh, yes, that's right, yes. So all these are uptrend. So if it's a downtrend, it's going to be an M. So it's 1, 2, 3. Oh, no. A, B, C. Oh, right, I see. Right, right. Oh, wait, not going downwards here. And C is like here. Right. Okay, I see, I see. So A, B, C, and then whatever. This should go down again, right? You begin counting the waves on the downtrend and you notice that A, B, C corrective waves are moving sideways. Is this a flat formation in the works? This means that price may just begin a new impulse wave once wave C ends. So potential sell wave 1. Trusting your Elliott wave skills, you go ahead and sell the market price in hopes of catching a new impulse wave. You place a stop just a couple of pips above the start of wave 4, just in case your wave count is wrong. Success, it goes all the way down. Trusting, yeah. Because we like happy endings, your trade idea based on the Elliott wave theory works out and nets you a couple of thousand pips on this day, which is not always the case. You have also learned your lesson this time around, so you skip Vegas and decide to use your profits to grow your Forex trading capital instead. Smart. Next, summary, Elliott wave theory. Summary, Elliott wave theory. Here's a summary of what we've covered regarding the Elliott wave theory. Elliott waves are fractals. Each wave can be split into parts, each of which is a very similar copy of the whole. Mathematicians like to call this property self-similarity. A trending market, okay, so Elliott waves are fractals. A trending market moves in a 5-3 wave pattern. Trending market moves in a 5-3 wave pattern. The first 5 wave is called impulse wave. First 5 wave is called the impulse wave. One of the 3 impulse waves, 1, 3 or 5, will always be extended. One of the wave 1, 3 or 5 will always be extended. Wave 3 is usually the extended one. Second 3 wave pattern is called a corrective wave. Second 3 wave is called the corrective wave. Letters A, B and C are used instead of numbers to track the correction. Waves 1, 3 and 5 are made up of smaller 5 wave impulse pattern. Okay, so waves 1, 3 and 5 are made up of smaller 5 wave impulse pattern. Waves 2 and 4 are made up of smaller 3 wave corrective pattern. There are 21 types of corrective patterns. There are 21 types of corrective wave patterns, but they're just made up of 3 very simple, easy to understand formations. The 3 fundamental corrective wave patterns are 3 fundamental corrective corrective wave patterns are zigzags, flats, and triangles. 3 cardinal rules. There are 3 cardinal rules in Elliott wave theory when labeling waves. 3 cardinal rules when labeling waves. Wave 3 can never be the shortest impulse wave. Wave 2 can never go beyond the start of wave 1, go beyond the start of wave 1. Wave 4 can never cross in the same price area as wave 1. If you look hard enough at the chart, you'll see that the market really does move in waves. Because the Forex market never moves in a textbook perfect fashion, it will take many hours of practice analysing waves before you start to get comfortable with Elliott waves. Stay diligent and never give up. Alright, quiz time. The Elliott wave theory. Do you think you know enough about the Elliott wave theory to pass our little quiz? Well, let's find out. What does truncation mean? Wave 5 does not move beyond the end of wave 3. Who is the founder of the Elliott wave theory? Ralph Lauren, Ralph Nelson Elliott, Elliott Spitzer, Missy Elliott, Ralph Nelson Elliott. The Elliott wave theory was first published in a book entitled The Elliott Wave Theory. Oh, never mind. Waves 2 and 4 are called impulse waves, or corrective waves. There are how many types? 21 types of ABC corrective patterns. Wave 2 cannot go beyond the start of wave 1. So the downward wave are always true. True or false? A minor wave is made up of minute waves. True? True or false? Triangle ABC corrective patterns are simple sideways corrective waves. Are simple sideways corrective waves. It's false, isn't it? The first 5-3 wave pattern is called the impulse wave. People started labeling the something wave as the extended one, as it tends to be longer than the other motor, the third. What are the 3 fundamental corrective wave patterns? Flats, zigzags, and triangles. What do you call the repetitive upward and downward price swings caused by the market's collective psychology? Waves. Waves 1, 3, and 5 are called motive. Waves 2 and 4 bounce off Fibonacci retracement level, sometimes. Cool. Very nice. Let's go to the next one. Harmonic price patterns in the Forex market. Now that you've got the classic chart patterns down, it's time to move on and add some more advanced tools in your Forex to your Forex trading arsenal. In this lesson, we'll be looking at harmonic price patterns. Unlike classic chart trading patterns, a harmonic pattern must meet specific movement requirements to be considered valid. So a harmonic pattern must meet specific movement requirements to be considered valid. These requirements reduce the subjectivity of trading harmonic chart patterns versus trading classic chart patterns. The movement requirements are based on Fibonacci retracements and Fibonacci extensions. The movement requirements are based on Fibonacci retracements and Fibonacci extensions. Okay, these bad boys may be a little harder to grasp, but once you spot these setups, it can lead to some very nice profits. The whole idea of these patterns is that they help people spot possible retracements of recent trends. Harmonic pattern is used to spot possible retracements of recent trends. In fact, we'll make use of other tools we've already covered, the Fibonacci retracement and extensions. Combining these wonderful tools to spot these harmonic price patterns, we'll be able to distinguish possible areas for a continuation of the overall trends. For a continuation of the overall trends. And possible areas for a continuation of the overall trend. In this lesson, we're going to discuss the following harmonic price patterns: the ABCD pattern, the 3 drive pattern, Gartley pattern, crab pattern, bat pattern, and butterfly pattern. Phew, that's quite a lot to cover, but don't you worry, once you get the hang of things, it will be easy as 1, 2, 3. We'll start off with the more basic ABCD and 3 drive patterns before moving on to Gartley and the animals. After learning about them, we'll take a look at the tools you'll need in order to trade these patterns successfully in the Forex market. For all these harmonic price patterns, the point is to wait for the entire pattern to complete before taking any short or long trades. For harmonic patterns, wait for the entire pattern to complete before taking any long or short trades. You'll see what we're talking about later, so let's get started. Okay, I am going to leave this episode here. So we finished with all the Elliott wave stuff, and we're doing harmonic price patterns. So yeah, in the next video we're going to be carrying on with this, with the ABCD and the 3 drive. So thank you guys for watching, and I will see you in the next video. Goodbye.